Hello, welcome to our proactive tax planning for the Secure Act workshop. My name is Paul Hutton. I'm president of Hutton Wealth Management. Before we begin, I find it always important to review the 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is going to be about the Secures Act, which affects retirement plans, tax planning, estate planning, and everything else. However, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation that we make, not just in one, but in all 5 of these key areas for our clients. The Setting Every Community Up for Retirement Enhancement Act of 2019, or the acronym, which is the Secure Act, is one of the largest assortments of retirement plan reforms in history. The Secure Act contains numerous provisions intended to make it easier for businesses to offer retirement plans and for individuals to save for retirement. It also made significant changes impacting existing retirement plans. One of the major changes enacted by the Secure Act was to change the age that requires retirement accounts owners to take what are called required minimum distributions, or RMD. The old law requires distributions to start in the year that you turn 70 and a half. The new law changed this to begin April 1st in the year that you reach 72. That's huge. Another major change enacted by the Secure Act was to remove the age limit that did not allow those with earned income to make traditional IRA contributions after 70 and a half. Now, you can make up to $7,000 contribution, which is a $6,000 regular contribution, plus a $1,000 if you're over age 50, extra contributions to a traditional IRA account if you're over 70 and a half. And it only if you have that much as earned income. So you have to have the earned income to be able to make that contribution. However, if you do not make this contribution over the age 70 and a half, it reduces how much you can use from your retirement funds in a qualified charitable distribution. If you're considering this new opportunities, please coordinate with us or your tax preparer for more details. While not part of the Secure Act, qualified charitable distributions, and we've talked about that on some of the other videos that we have, is a strategy for retirement savers. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from the retirement accounts after age 70 and a half and not pay taxes on that distribution. One idea that experts suggest is that if you're charitably inclined, consider using part or all of your required minimum distribution, your RMD, for a qualified charitable distribution, a QCD. Like many other strategies we are discussing today, this is one that you should see us about if you're interested in evaluating your personal situation. Another major change enacted by the Secure Act was to create some new 529 plan rules. They include the ability to use up to $10,000 in your lifetime for qualified student repayments. That's nice. Another major change enacted by the Secure Act was to remove the 10% retirement account penalty for up to $5,000 of retirement funds withdrawn if you're under the age of 59 and a half. This is only for expenses incurred within a year of your first child's birth or adoption. There are abilities to repay this into the plan, so if this is a strategy you'd like to look at, let us know. We'd be happy to sit down and visit with you. The Secure Act made sweeping changes to how investors need to take funds from retirement accounts after the death of an owner, and this is going to impact everyone. The new Secure Act created a 10-year rule that basically requires all inherited IRAs, Roth IRAs, and other qualified plans to be distributed within 10 years from the date of the person's death. It does make exemptions for certain types of beneficiaries, and those are surviving spouses, the employee's children that are under the age of 18 or majority, not to count grandchildren or other children. It does include disabled individuals, chronically ill individuals, and non-spousal beneficiaries who are less than 10 years younger than an IRA owner. For example, say a sibling that's 7 years younger than you. Under the old rules, IRA owners could leave their IRA to heirs who could then stretch their withdrawals over their inheritors' lifetime. This new rule, the 10-year rule, says that there is no requirements for annual distributions. The account just has to be fully distributed by the end of the 10th year, following the year of the account owner's passing. Your objective is still to reduce your taxes and to take advantage of tax deferral as long as possible. Here's a warning though. For some beneficiaries, the 5-year rule may apply. So talk with a tax advisor to evaluate your situation. Please also remember that plan documents or a company's retirement plan can override the 10-year rule. So this changes many of the planning strategies that experts recommend. According to some experts, the old rules, best practices was whenever possible, leave all of your retirement assets to your spouse who, upon their passing, would then leave it as an inherited IRA to your children, who would then have the option to stretch it out over their lifetime. This enabled a potential longer period of tax deferral, and hopefully those assets would grow. Let's talk about the spousal rollover. If you now leave your retirement assets to your spouse, they still must take distributions over their lifetime. As this example shows, a spouse dies 8 years later, and then that person leaves it to the beneficiaries who are subject to the new 10-year rule. Let's see here. When we're talking about this could potentially create a tax liability over more brackets and more years by leaving part of your inheritance to your surviving spouse and then passing it on to your children's at a later point in time. Back to the example. When your spouse dies after 8 years, during their 8 years of life, your spouse and beneficiaries who have had 10 years to take out their inheritance could be taking distributions, and then after the spouse dies, their beneficiaries are subject to the new 10-year rule on the final amounts left. This strategy would potentially, if it makes sense tax-wise, spread the tax burden over 18 years, not just 10. The new 10-year rule is extremely complicated, and we'd be happy to visit with you about that in more detail if you'd like. The new 10-year rule reminds us that a proactive approach could potentially reap rewards. To maximize your situation under the new 10-year rule, you may want to consider doing a Roth conversion and possibly spreading the distributions over many years at a lower tax bracket. Unlike distributions from regular IRAs, Roth IRA qualified distributions are not taxed. A critical area to review because of the Secure Act is what we refer to as the overall family tax bracket management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take the distribution in their tax bracket rather than yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket now, convert these assets to a Roth IRA, and then leave them to the kiddos who still have 10 years to take it out, but it can grow tax-free. The first step is to review your marginal tax bracket and the beneficiary's marginal tax bracket each year. So let's review the rates for a minute. Here are the current tax rates for married filing jointly and single payers. Married filing jointly has a lower rate on many amounts. Something that you need to remember is that even if no changes are made to tax rates, then in 2026, the law says we go back to the older, higher rates. So when making your plans, we need to remember that. Let me say that again. The tax law calls for a sunset in 2026. So the law says we go back to the higher rates automatically in 2026. As this arrow shows, for some people, that means larger withdrawals could mean what is today taxed at 24% could be potentially taxed in 2026 at 33% or even a much higher rate. How can you make the mathematics of an IRA conversion work for you? Well, your personal critical decision factors need to include your current tax rate, your differentiation, the use of outside funds to potentially pay the income tax liabilities, the need for IRA funds to meet your annual living expenses, required minimum distributions considerations. Remember, if you convert to a Roth IRA, Roth IRAs do not have required minimum distributions. We need to take into consideration your time horizon. How old are you, and how long can you defer the taxes? We need to look at your estate tax considerations. Then we need to take into consideration the 10-year rules. This is not an easy choice, and we can help you with that. So just let us know, and we'd be happy to go over your personal situation. Many experts believe that there's a sweet spot for considering using partial Roth IRA conversions, or what we call, we're going to fill up as much as we can. So we're going to be looking at trying to fill up the 24% tax bracket, and after the sunset go as high is filling up to the 28% tax bracket. Again, we can help you review this particular situation. Some of the other reasons to consider doing a Roth conversion, if appropriate, include tax brackets could rise in future years, and your account values might go down from the drop in the market. Some benefits from the Roth IRA conversion include they could lower the overall tax and income long term. Roth IRAs enjoy tax-free compounding returns. Roth IRAs have no required minimum distribution, or RMDs, at age 72. Roth IRAs allow for tax-free withdrawals for beneficiaries. These are huge benefits. As part of our family tax bracket management strategy, we also want to confirm the beneficiaries and contingent beneficiaries. To maximize your options for transferring this wealth, we should check your primary beneficiaries and your contingent beneficiaries. Whatever strategy we end up evaluating and using will help us coordinate your opportunities with your tax preparer. As a recap, what are some of the key takeaways? Well, let's go over these again. The Secure Act has a permanent change in retirement plans. Your situation in the new 10-year rule needs to be reviewed. Our goal is to help clients understand your choices. Your health is our highest priority. Continue to focus on personal goals and call us whenever you have concerns. So, what can you expect from us? I want you to know that you can expect regular communications, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. I want to thank you for your time today. Remember, your health and your well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs. Now, I need some help for you in 2021. In fact, I would be honored if you could share the names of some of your friends or family to share this video with, or add them to our mailing list so that they can benefit from the same information. Again, we want to thank you for your time today, and remember, a proactive approach can many times lead to much better results than a reactive one.